Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, October 28th, 2024. First of all, I want to apologize. I was out last week and failed to mention that the podcast before, so we did miss a week. Sorry for those of you who were looking for it. So, this week, going through the economic activity that was released the prior week, last week. We'll start off by just mentioning it was a pretty light week, number one. Number two, of the economic data that was released, neutral to good. We had three economic indicators that were real estate home related, and those were relatively inconsequential. We'll go through those, and then we had durable goods and consumer sentiment. But existing home sales last week came in a little weaker than expected, 3.84 million, close to consensus. Building permits, likewise, barely below consensus. Then we had new home sales that came in actually better than expected, 738,000, 720,000 expected. I mentioned durable goods. Durable goods came in both metrics better than expected. Durable goods orders and durable good orders ex-transportation. So the durable good order, the headline number, came in at a negative 0.8 month over month for the month of September. That was better than consensus of down a full percent. And durable goods orders ex-transportation came in a positive 0.4% month over month in September. It was actually expected to be down slightly, down 10 basis points. And the last economic data point from last week, Michigan's Consumer Sentiment Index. It's a little surprising, it's up again. So it was the expectation was 69. It came in at 70.5. We take a look at the third quarter expectations. Now, we're going to get the actual number this week, but just reviewing the fact that the Atlanta Federal Reserve believes during the third quarter, U.S. economy very healthy, believes we grew 3.3%. The prior week, they were at 3.4%, so they took it down just slightly. That would be very strong economic growth in the third quarter. Inflation expectations hardly moved last week, down a little bit, but the expectation is for inflation to average 2.29% over the next 10 years. Fed funds. So we will have another Fed FOMC meeting on November 7th. They will release the rate decision, and it's almost a foregone conclusion. They will drop another 25 basis points. Recall last Fed meeting, they dropped 50 basis points, so about a 96% probability that we'll get one and only one cut during this November meeting. And then the December meeting, the expectation is we will get one more cut. However, expectations have come down so significantly over the last month that the expectation a month ago was 50-50 odds that we would get three cuts. Now the third cut is definitely off the table. Zero probability priced into the Fed funds future market of that happening at this point. So, market reaction last week to the economic news. Now, we also had corporate earnings, which were admittedly mixed last week. We won't focus on it. A big week this week. We'll probably talk about it next week. But last week, equity markets, both domestic and international and fixed income, all three, down for the week. S&P 500 down just less than 1%, negative 0.96%. The underlying strength in the market, NASDAQ up slightly, 0.16%. The rest of the market clearly down. Small cap down, value down last week. So growth last week actually outperformed value, down 69 basis points to negative 2.17% for value in the United States. Also, domestic, while it was down, using the S&P 500 as the domestic proxy, it was better than world markets. So world developed markets, ex-US, down nearly 2%, down 1.97%. In emerging markets, also down more than the S&P 500, down 1.79%. Fixed income. Just a month ago, I think we probably mentioned on this podcast the fact that we had such a strong rally in fixed income. We just noted The fortunes turned dramatically. Almost as quickly it's gone the other way. So over the last month, a lot of the gains that we got in fixed income have been eroded. Last week, the Bloomberg U.S. Aggregate Bond Index down 92 basis points. We had the 2-year and the 10-year yield, both of those up 16 basis points for the week. So now on a year-to-date basis, just a quick recap, S&P 500 up a little over 23% for the year, definitely outperforming international markets. Growth slightly outperforming value. In terms of the international markets, developed markets ex-US up nicely, but a paltry 6.2% versus the S&P 500 of positive 23%. Emerging markets also positive, well below the S&P 500. Emerging markets up 10.86%. And the Bloomberg U.S. Aggregate Bond Index that we mentioned has given up a lot of ground over the last 4 weeks. Still positive, but now a positive 2.03% on a year-to-date basis. So economic activity that will be released this week. A lot of economic activity, much more than last week, but we'll just focus on the ones that we think will actually move the market. So investors very focused on inflation. Federal Reserve very focused on inflation. We'll get the PCE number, core PCE, and headline PCE data. That'll come on Thursday. Both of those metrics are expected to be up higher than they were in the month of August. So for the September number, the expectation is the core PCE number up 0.3% month over month. Month of August, that was only up 0.1%. And PCE headline number expected to be up 0.2%. And again, in August, that was only up 0.1%. The big number we think this week will be the non-farm payroll number. That will be released on Friday. You may recall a month ago, and this really changed, this is when the bond market really rolled over, is the hiring or the jobs added for the month of September was much higher than expected. It came in at 254,000. Consensus was about 160,000, so a huge beat. Not sure where all that strength came from, some from the government clearly, but it was an outlier, so investors were quite surprised. Well, for the month of October, the expectation is less than half of that. The expectation is, well, I've added 123,000 jobs for the month of October versus at 254. We'll also get the unemployment rate. That's expected to be static at 4.1%. As well, we'll get the average hourly earnings. That is actually expected to be decelerate a little bit. That's expected to be up 0.3% versus the prior month up 0.4%. So that's it. That's a recap of last week, how the markets did, and a preview of this week's economic activity. Thank you very much for your attendance. We'll look forward to seeing you next week. Thank you.